You have 47 trading strategies saved in a folder on your desktop, 17 browser tabs open with chart patterns you're supposed to memorize, 3 courses you bought but never finished, 2 Discord servers you check every morning, a notebook filled with rules from different methodologies that contradict each other. You watch YouTube videos before the market opens trying to absorb one more edge, one more confirmation signal, one more way to read price action. You screenshot trades from people on Twitter who seem to have it figured out. You save templates, you bookmark threads, you tell yourself that this time, with this next piece of information, it's all gonna click. And yet, when you sit down to trade, something strange happens. You hesitate. You see a setup that matches the criteria you learned, but you're not sure if this is the right context. You check 3 different time frames, you look for confluence, you wait for one more confirmation. By the time you decide, the entry is gone, or worse, you take it late and it immediately goes against you. So you close it. Then you watch it reverse and hit your target without you. This happens again and again. Some days you overtrade, jumping into setups you barely recognize because you feel like you're missing out. Other days you freeze completely, watching opportunities pass because nothing looks exactly like the examples you studied. You tell yourself you just need to learn more, master more setups, understand more contexts, build a bigger toolkit, because that's what makes sense, right? The more you know, the more opportunities you can catch, the more edges you can deploy, the more adaptable you become. You switch between strategies mid-week because one stopped working or another looked more promising in a video you watched. You add indicators, then remove them. You try discretionary trading, then switch to mechanical rules, then blend the two. You're constantly adjusting, constantly optimizing, constantly searching for the missing piece. But here's the strange part. The traders making consistent money aren't the ones who know the most. They're not the ones with the most complex systems or the most sophisticated indicators. They're not the ones who can identify 30 different candlestick patterns or explain every market structure concept. They're the ones who see the least and see it deepest. They're the ones who, when you ask them what they trade, give you an answer so simple it almost sounds naive. They trade one thing, maybe 2, and they've been trading that same thing for years. They're not bored. They're not looking for new strategies. They're not in the courses and communities collecting more information. They're just watching their one pattern day after day, and somehow that's enough, more than enough. This isn't about work ethic. It's not about discipline or intelligence or screen time or how many books you've read or how much money you've spent on education. It's about something else entirely. Something most people don't realize is happening inside their own perception. Because what looks like a knowledge problem is actually a recognition problem, and recognition doesn't come from breadth, it comes from repetition so specific that your brain stops thinking and starts seeing. It comes from constraint, not expansion, from depth, not width, from seeing the same thing so many times in so many different contexts that it becomes part of your perceptual apparatus, not something you look for, something you can't help but see. Let's reframe what's actually happening when you collect strategies. You believe you're building a toolkit. You think that if you know 10 setups instead of 3, you'll catch more opportunities and make more money. It makes logical sense. More tools, more options, more edge. It's the same logic that drives people to learn multiple languages or collect multiple degrees. Optionality, flexibility, preparedness. But this misunderstands how pattern recognition forms in the human brain, and more importantly, it misunderstands the nature of trading itself. Trading isn't like having tools in a toolbox where each tool serves a distinct function and you pull out the right one for the right job. Trading is more like language fluency. You don't become fluent in French by also learning German, Spanish, Italian, and Portuguese at the same time. You become fluent in French every day for years until you stop translating and start thinking in French, until the grammar becomes invisible, until you recognize idioms instantly, until you can feel when something sounds wrong even if you can't explain why. That's fluency. And that's what you need in trading. Not more strategies, fluency in one. When you expose yourself to dozens of different setups, each with its own rules and contexts and nuances, you're not building mastery, you're building noise. You're creating a mental environment where everything is slightly familiar but nothing is deeply known. Your brain never gets the repetition it needs to move a pattern from conscious analysis to automatic recognition. Every time you switch focus to a new setup, you reset the clock, you restart the learning process. You're back at the beginning, trying to memorize rules, trying to understand context, trying to build experience from scratch.
And because trading happens in real time with real consequences, with money on the line and emotions engaged, you never give your brain the thousands of exposures it needs to truly encode a single pattern into deep memory.
Think of it this way. A radiologist doesn't learn to spot tumors by studying every possible medical condition. They don't spend 1 month on cardiology, 1 month on neurology, 1 month on gastroenterology. They specialize. They look at thousands of the same type of scans until the anomaly jumps out before they even consciously process it. They develop what researchers call expert perception, the ability to see patterns that are invisible to novices, not because they're smarter, but because their brains have been shaped by focused repetition. The neural pathways for that specific pattern have been reinforced so many times that recognition becomes automatic. A chess master doesn't memorize every opening in existence. They play the same openings over and over until they stop calculating and start feeling the position. They know when something is wrong even if they can't immediately articulate why. They see threats that won't materialize for 10 moves, not because they're calculating faster than you, but because they've seen similar positions hundreds of times. The pattern is in their bones. A jazz musician doesn't learn every scale in every key. They master a few scales so deeply that they can improvise without thinking. Their fingers know where to go. The music flows. The brain builds fluency through constrained repetition, not broad sampling. This is true across every domain that requires real-time pattern recognition under pressure, and trading is absolutely one of those domains. When you trade 15 different setups, you're asking your brain to become fluent in 15 different languages at once. It can't, so it stays stuck in translation mode, forever analyzing, never recognizing, forever thinking, never seeing. You're trading from your conscious mind, which is slow and energy intensive and prone to interference from emotion and doubt. You never get to trade from your subconscious, which is fast and effortless and unshakable. Now let me show you what this looks like in practice, because the contrast is striking once you see it. Two traders start at the same time. Both are intelligent, both are disciplined, both have access to the same information, both have similar account sizes, both want the same thing, which is to become consistently profitable. From the outside, they look identical, but the path they choose diverges immediately, and that divergence compounds into completely different outcomes. The first trader, let's call him Daniel, takes the completionist approach. He's thorough, he's diligent, he wants to understand everything before he commits to anything. So he starts with the basics, support and resistance. Makes sense. He spends 2 weeks learning how to draw levels. Then he moves on to moving averages, another 2 weeks understanding how they work as dynamic support and resistance. Then MACD divergence, then candlestick patterns, then volume analysis, then market structure, then supply and demand zones, then ICT concepts, then order blocks, then liquidity grabs. Every week he adds a new layer. He's not rushing, he's being responsible. He's building a complete understanding of how markets work. His charts evolve over time. They start simple and become increasingly complex. More lines, more indicators, more zones marked. He can look at a chart and identify 10 different potential setups. He sees a failed auction at support, a bullish divergence on the MACD, a hammer candle at a key level, a break of market structure, a volume spike. He sees everything. His watch lists are enormous because he's looking for setups across all time frames and all contexts: stocks, Forex, crypto, scalps, day trades, swing trades. He's flexible, adaptable, open-minded. He feels like he's progressing because he's learning. His notebook is full. His understanding is expanding. He can have sophisticated conversations about trading. He knows the terminology. He understands the concepts. And yet, 6 months in, his account is flat. Actually, it's slightly down after commissions. He's had wins and losses, but they cancel each other out. Some weeks are good, some weeks are bad. There's no consistency, no clear edge, no sense of progress beyond the intellectual understanding. He looks at his trading journal and sees a mess. 20 different setups traded. Some worked, some didn't. He can't tell why. He can't identify a pattern in his own performance because there's no pattern to identify. Every trade was different, every decision was unique, every outcome was random. He blames execution.
He tells himself he's seeing the setups correctly, but entering at the wrong time, or exiting too early, or holding too long. So he works on his psychology. He reads trading psychology books. He tries meditation. He makes rules about not overtrading. But none of it helps because the problem isn't psychological. The problem is perceptual. He's trying to execute a strategy, but he doesn't actually see the strategy. He's analyzing whether the current price action matches the criteria he learned, and by the time he finishes analyzing, the moment has passed or his conviction is too weak to hold through normal volatility.
He watches other traders post their wins and feels confused. What do they see that he doesn't? Why are they confident when he's uncertain? He assumes it's discipline or mindset, or maybe they're just more talented. So he keeps learning. He buys another course. He joins another mentorship. He thinks the answer is out there somewhere in the next video, the next book, the next concept. He just hasn't found it yet. The second trader, Maya, takes a different path. Her beginning looks similar to Daniel's. She starts learning the same concepts: support and resistance, chart patterns, indicators. She watches the same videos, she reads the same books, but in her first month, something happens. She stumbles on one setup that makes sense to her, a simple breakout pattern with two confirmation signals. Nothing fancy, nothing proprietary, just a clear structure she can recognize. A consolidation range that builds for at least 15 candles, then a breakout on increased volume with a candle that closes strong, then a pullback to the breakout level that holds. That's it. 3 simple elements. She sees it work a few times, she sees it fail a few times, and for some reason, this pattern resonates with her. It feels readable, predictable, clear. Now here's where her path diverges. Instead of moving on to learn the next pattern, she stops. She makes a decision that feels counterintuitive. She decides this is the only setup she'll trade, not temporarily, not until she masters it, but indefinitely. This is her setup now. She stops watching videos about other strategies. She stops reading about new concepts. She doesn't join communities where people are sharing the latest edge or the newest indicator. She just focuses on this one pattern. Every morning, she opens her charts and looks for this specific setup. That's it, nothing else. At first, it feels constraining. She sees other patterns forming, other opportunities. She feels like she's leaving money on the table. Her friends who started trading at the same time are learning all these sophisticated concepts, and she's just watching one simple pattern. She feels like she's falling behind, like she's not growing, but she sticks with it, not because she's more disciplined, but because something tells her this is the right path. For the next 6 months, she watches this pattern and only this pattern. She sees it form hundreds of times. She sees it work. She sees it fail. She starts to catalog the failures. Breakouts that fail happen when the consolidation is too short, or when the breakout candle is large but the volume isn't really there, or when the pullback comes too quickly within 3 candles of the breakout. She starts to notice these things not from analysis but from pure exposure. She's not trying to find these nuances. They reveal themselves through repetition. She sees the pattern in uptrends and downtrends, during high volatility and low volatility, after earnings and during dead zones, in stocks that are liquid and stocks that are choppy. She starts to develop an intuition for when the setup is high probability and when it's marginal. She can't always explain it, she just feels it. The setup looks right or it doesn't. By month 3, she's taking fewer trades than she did in month 1, but her win rate is climbing. She's not trading every breakout anymore. She's trading the good ones. The difference is subtle but critical. By month 4, something shifts. She's not analyzing the setup anymore, she's recognizing it. The moment she sees a consolidation forming, she's already tracking it. She's not thinking about the rules, she's just watching. When the breakout happens, she doesn't have to check the criteria. She knows instantly whether this is her trade or not. Her entries become cleaner, her conviction becomes stronger. When she enters a trade now, she's not hoping it works, she's expecting it to work because she's seen this exact structure succeed so many times that her brain has encoded it as a high probability pattern. Her psychology changes without her trying to change it. She's not anxious anymore. She's not second guessing. She's not checking other people's trades to validate her own. She's just trading her setup. When it works, she's satisfied but not euphoric. When it fails, she's disappointed but not devastated. She trusts the process because the process has proven itself over hundreds of observations. By month 6, her account is up 38%, not from one massive win, but from consistent execution of one pattern that she now sees with absolute clarity.
The contrast between Daniel and Maya isn't about intelligence or discipline, it's about focus. Daniel spread his attention across a wide surface. Maya concentrated hers on a single point. Daniel learned more concepts but mastered none. Maya learned one concept and mastered it completely. Daniel sees everything but recognizes nothing. Maya sees one thing and recognizes it instantly. And in trading, recognition is everything.
Here's what's happening neurologically. And this is important because once you understand this, you'll see why the one setup approach isn't just effective, it's necessary. Every time you observe a pattern, your brain creates a weak trace, a potential pathway, a loose connection between neurons. This trace is fragile. It decays quickly if it's not reinforced. If you observe that same pattern again soon after, the pathway strengthens. The connection becomes a little more permanent. Do it 100 times, the pathway becomes a road. Do it 1,000 times, it becomes a highway. This is how all skill develops, through repeated exposure to the same stimulus in varying contexts. But here's the critical part. The repetition has to be focused. If you're trying to build 10 highways at once, none of them get the traffic they need to solidify. You end up with a maze of half-formed dirt paths. Some lead somewhere, some don't, and you can't tell which is which until you're already halfway down. Every time you sit down to trade, your brain has to consciously choose which path to follow. This creates decision fatigue before you even enter a position. Should I trade the breakout, or wait for the MACD divergence, or look for the failed auction? Each question burns mental energy. Each decision point is a place where doubt can creep in. By the time you've analyzed whether this is an MACD setup or a breakout setup or a pullback setup, by the time you've checked whether the context is right, whether the time frame aligns, whether you have enough confirmation, the opportunity has moved. The edge has degraded. Or worse, you take the trade with hesitation, and hesitation kills conviction. Without conviction, you exit too early when the trade pulls back normally, or you hold too long after your stop is hit because you're not sure if the setup is actually invalidated or if this is just noise. The pattern might have worked, but your execution didn't, and you can't separate the two because you don't have enough experience with that pattern to know what normal behavior looks like. When you trade one setup, you remove the decision layer. You're not choosing between strategies. You're not wondering if this context fits. You're not questioning whether you have enough confirmation. You see the pattern or you don't. This is the difference between recognition and analysis. Analysis is slow. It's conscious. It happens in your prefrontal cortex, which is the part of your brain responsible for executive function. It's also the part that gets overwhelmed by emotion, that gets fatigued by too many decisions, that second-guesses itself under pressure. When you're analyzing, you're vulnerable. Recognition is instant. It's subconscious. It happens in deeper, older parts of your brain that process visual patterns automatically. These systems don't get fatigued. They don't doubt. They just see. When you spot a friend's face in a crowd, you don't analyze the features. You don't consciously check the nose, then the eyes, then the mouth. You just know. That's recognition. And that's what trading from a place of mastery feels like. You're not thinking your way through the setup, you're seeing it. And seeing is faster, more accurate, and emotionally neutral. This speed of recognition determines quality of execution. The trader who sees the setup immediately enters with full conviction. They're not hoping, they're not guessing, they're acting on pattern recognition that's been reinforced thousands of times. Their stop is clear. Their target is clear. They're not watching the trade tick by tick, trying to interpret every move. They're just managing a position according to a plan that's been proven. The trader who has to think about which setup this is enters with doubt. They're not sure if this is the right trade. They're not sure if they're seeing it correctly. So they enter smaller. They exit quicker. They override their plan when things get uncomfortable. Same pattern, different outcome. The difference isn't the market, it's the trader's internal state, and that internal state is shaped by how deeply the pattern is encoded in their brain. There's a principle here that most people miss, and it's worth naming explicitly. We could call it deep pattern literacy. It's the idea that surface knowledge of many things is worth less than deep knowledge of one thing. Not in every domain, but definitely in domains where you have to act under pressure with incomplete information and immediate consequences. Trading is one of those domains. So is investing. So is poker. So is negotiation. So is reading people. So is any form of real-time decision-making where you can't pause to think.
In these fields, the person who knows one thing at the level of intuition will outperform the person who knows 10 things at the level of theory, every single time. Because intuition is what allows you to act without hesitation. Intuition is what gives you conviction. Intuition is what keeps you calm when the position moves against you normally, because you've seen this exact scenario before and you know how it usually resolves. And in markets, hesitation is the gap where opportunity disappears. Hesitation is where profits turn into small losses. Hesitation is where you exit right before the move you were waiting for.
Theory sounds good in hindsight. Theory makes sense when you're analyzing charts that already happened. But theory crumbles under the pressure of real-time decision-making because theory lives in the slow brain, the part that thinks, the part that questions, the part that gets hijacked by fear and greed. Intuition lives in the fast brain, the part that sees patterns automatically, the part that doesn't question because questioning isn't part of its function. It just recognizes and reports. Deep pattern literacy compounds over time in a way that broad knowledge doesn't, and this is where things get really interesting. When you've seen your one setup 1,000 times, you start to see second-order details, subtleties that aren't in any course or book because they're too nuanced to teach explicitly. You notice how the pattern behaves differently on Mondays versus Fridays, how it changes character in the first hour of the session versus the last hour, how it performs differently when the market is in a strong trend versus when it's choppy, how it looks different in high IV rank versus low IV rank. These aren't things you're looking for. They're things you notice because your brain has become so attuned to this specific pattern that variations stand out automatically. You develop a feel for when the setup is likely to fail, even if all the technical boxes are checked. Maybe the consolidation formed correctly, but something about the price action inside the range feels heavy. Maybe the breakout candle looks good, but the volume profile doesn't match what you usually see when the move sustains. Maybe the pullback held the level, but the reaction off that level feels weak. These observations are impossible to codify into rules because they're based on feel, not data. But they're incredibly valuable. This is edge, real edge, the kind that can't be taught or sold, the kind that only comes from thousands of hours of focused observation. And here's what most people don't realize. This edge doesn't come from knowing more. It comes from seeing deeper. You can't see deeper if you're constantly looking at new things. Depth requires time. It requires boring, repetitive exposure to the same stimulus until the obvious becomes invisible and the subtle becomes obvious. Most traders never get here because they switch strategies before the deep learning happens. They collect breadth but never build depth. They know a little about everything, but not enough about anything to trade it with genuine confidence. So what does the daily rhythm of this look like? What does it actually mean to trade one setup? Because I think most people hear this advice and they conceptually agree, but they don't know how to implement it. They don't know what to do on the days when their setup doesn't appear. They don't know how to maintain focus when other opportunities are screaming for attention. They don't know how to resist the pull of new information, new strategies, new edges. So let me walk you through this in detail, because the daily rhythm is where the theory meets the behavior. You start by choosing one setup, just one. And this is harder than it sounds because you have to commit. You have to close the door on everything else. It could be anything: a breakout from consolidation, a pullback to a moving average in a strong trend, a failed auction at support, a liquidity grab that reverses, a retest of a broken level. It genuinely doesn't matter what it is. What matters is that it has clear entry and exit rules, that it shows up often enough that you can observe it regularly, at least a few times per week, that it makes intuitive sense to you, that you can explain why it works in one sentence. Once you've chosen, you stop learning new strategies completely. This is the hard part. This is where most people fail, because stopping feels like stagnation. It feels like you're closing yourself off to better opportunities. You'll see other traders posting wins from setups you don't trade. You'll watch videos explaining patterns you don't know. You'll feel the FOMO, the fear that you're missing out on edge, on knowledge, on profit. But you have to resist. You have to understand that every minute you spend learning a new strategy is a minute you're not deepening your understanding of your one strategy. Every new concept you add is cognitive load you're removing from pattern recognition. You're trading future mastery for present optionality. And optionality feels good,
but mastery is what makes money. So you close the courses, you leave the communities where people are constantly sharing new strategies, you unsubscribe from the YouTubers who post daily videos about the latest edge. You might keep one or two resources that focus on your specific setup, but even then, you're selective. You're not collecting information, you're refining understanding. There's a difference. One is broad and shallow, the other is narrow and deep. Every day, you do the same thing. You open your charts and you look for your setup. That's it. You don't look for anything else. You don't scan for other opportunities. You don't browse different assets hoping something catches your eye. You have a watch list of instruments that tend to show your setup frequently, and you check those. If you see your pattern forming, you watch it. If you see your pattern trigger, you trade it. If you don't see it, you close your charts and you do something else. You don't force trades. You don't get creative and try variations of your setup. You wait. This waiting is crucial. This is where discipline actually matters. Not the discipline to take every trade, but the discipline to take only your trade. Most traders think discipline means pushing through discomfort to do the hard thing, but in trading, discipline often means doing nothing. It means sitting on your hands when there's action happening that doesn't fit your criteria. It means watching other people make money on setups you don't trade and being okay with that. It means being so committed to your one pattern that everything else becomes noise, no matter how compelling it looks. When you watch, you're not passive. You're studying. You're building your mental database. Let's say your setup is a breakout from a tight consolidation. You see a stock consolidating. It's been in a range for 18 candles. The range is clean, but your rules say it needs at least 20 candles, so you wait. You watch what happens. Does it break out successfully even though it was only 18 candles, or does it fail? You note this, not in a spreadsheet necessarily, but mentally. You're building a catalog of outcomes. Over time, you'll see this scenario 50 times. Maybe 30 times it fails. Maybe 20 times it works. Your brain starts to encode a probability. Consolidations under 20 candles are lower probability. Not impossible, but marginal. You didn't learn that from a book. You learned it from observation. Or maybe you see your pattern trigger and you take the trade. It immediately goes against you and stops you out. Frustrating. But instead of moving on, you watch what happens next. Does it reverse and hit your target without you, or does it continue failing? If it reverses, you study why. Was your stop too tight, or was there something about the initial setup that you missed? Maybe the volume wasn't actually strong. Maybe the breakout candle closed near its low instead of its high. Maybe the consolidation was right at resistance instead of an open space. These details matter, but you can't see them if you're trading 30 different setups because you'll never accumulate enough examples of each to identify the patterns within the pattern. You take screenshots, not to create a massive library that you never look at again, but to build a reference. You organize them simply: wins, losses, break even. Within each category, you might note the context: strong trend, weak trend, range-bound, high volatility, low volatility. Over time, you start to see which contexts produce the best results. Maybe your setup works best in trending markets and fails in choppy markets. That's valuable information. Now you know to be more selective when the market is range-bound. Or maybe it's the opposite. Maybe your setup works in any condition. Also valuable. You won't know until you have enough data, and you can't get enough data if you're spreading your attention across multiple patterns. You start to see the pattern not as a set of rules, but as a living structure that changes shape slightly depending on context. The rules are still there, they're the foundation, but you learn to read the variations. You learn that the pattern looks slightly different on a weekly chart than a daily chart, that it behaves differently in small cap stocks than large cap stocks, that it works better after certain types of news than others. These insights don't come from thinking harder. They come from seeing more, from exposing yourself to the pattern so many times that your brain starts to extract second-order statistics automatically. Some days, you'll get frustrated. You'll think this is too narrow. You'll wonder if you should add a secondary setup just to catch more trades, just to use your time better, just to feel like you're doing something. Don't. That's the trap. That's the moment where most traders break. They can't handle the simplicity. They can't handle the boredom because our culture tells us that more is better, that busy is productive, that complexity is sophisticated. But in trading, simple is powerful, boring is profitable, repetition is where mastery lives. The moment you split your focus, you slow down the recognition process for both setups. You're not doubling your opportunity, you're halving your depth. You're restarting the clock on building fluency in the second setup, which means you won't reach fluency in either for twice as long. It's not addition, it's division. Stay with the one setup. Let the boredom come. Let it wash over you, because boredom is actually a sign that your conscious mind is stepping back. It's a sign that the pattern is moving from conscious processing to subconscious encoding. This is good. This is the goal. You want to reach the point where you're not thinking about the setup, you're just seeing it.
There's a phase around month 3 or 4 where it feels like nothing is happening. You're watching the same pattern, you're taking similar trades, your results are flat or slightly positive, but not explosive. This is the phase where most people quit. They think the setup doesn't work, or they think they've learned everything there is to learn and they need to move on to the next level. But this phase is actually the most important phase. This is where the deep encoding happens. This is where the neural pathways are being built. You're not seeing the progress because the progress is happening beneath conscious awareness. Your brain is restructuring itself to recognize this pattern automatically, but that restructuring takes time, it takes repetition, it takes trust. If you push through this phase, something shifts around month 5 or 6. Suddenly, the pattern that felt mechanical starts to feel intuitive. You're not checking the rules anymore, you just know when it's right. Your entries become cleaner, your stops feel obvious, your targets make sense. You're not trading from your mind, you're trading from your gut. And your gut is accurate because it's been trained on hundreds of examples. This is when trading starts to feel easy, not because the market got easier, but because your perception got clearer. Now let's talk about what happens if you ignore this. If you keep collecting strategies, keep switching systems, keep looking for the next edge, the obvious consequence is that you never build fluency in anything. You're perpetually a beginner at 10 different things instead of an expert at one thing. But there's a subtler cost that I think is even more damaging. You start to lose trust in yourself. Because every time a setup doesn't work, you don't know if it's because the setup is bad, or because you executed poorly, or because the context was wrong, or because you didn't understand the setup deeply enough. There are too many variables, too many unknowns, so you can't learn from the failure, you can't adjust. All you can do is assume something was wrong and try something different. So you move to a different setup. You tell yourself this one makes more sense, this one fits your style better, this one has a higher win rate according to the person teaching it. You trade it for 2 weeks, it works a few times, it fails a few times. You don't know if that's normal variance or a sign that it doesn't work. You don't have enough data. So when you hit a string of losses, you assume the setup is bad and you move on. Then that one doesn't work, so you move again. Over time, this becomes a pattern in itself, a meta-pattern, a pattern of seeking instead of mastering. And seeking feels productive. It feels like learning. It feels like you're taking action, making progress, building skills. But it's not. It's avoidance. Because mastery requires you to sit with one thing long enough to see it fail, long enough to understand why it failed, long enough to adjust your understanding and try again. If you keep switching, you never get that feedback loop. You never develop the internal compass that tells you when to take the trade and when to pass. You're forever dependent on external validation, on someone else's strategy, on the next course or indicator or mentor or community. You never become your own authority. There's also an identity cost, and this one is psychological, but it has real consequences. When you trade multiple setups, you see yourself as a generalist, a student, someone who's still figuring it out, someone who's building a foundation, and that identity shapes your behavior in subtle ways. You trade with the mindset of a learner, which means you're cautious and unsure. You second-guess yourself. You look for confirmation from others. You check if other people saw what you saw. You ask for opinions. You need validation before you commit. And all of this erodes your conviction, which erodes your execution, which erodes your results. But when you trade one setup for months or years, your identity shifts. You start to see yourself as a specialist, someone who knows one thing deeply, someone who has a skill that's been honed through repetition. And that identity change is subtle but powerful. It changes how you enter trades. You're not hoping anymore, you're executing. You're not unsure anymore, you're confident. Not arrogant, not reckless, but confident in the pattern because you've seen it prove itself hundreds of times. That confidence changes how you hold through volatility. When your position pulls back, you're not panicking. You're not wondering if you're wrong. You know this is normal behavior because you've seen this exact scenario 50 times before. You know it usually bounces, so you hold. And often that hold is the difference between a scratch trade and a winner. How you respond to losses changes too. A generalist takes a loss and questions everything. Was the setup wrong? Was the execution wrong? Was the market wrong? Was I wrong? There are too many variables to isolate the issue, so they spiral. They lose confidence. They start trading smaller. They start skipping setups that actually look good because they're afraid of another loss. A specialist takes a loss and contextualizes it. They know their win rate. They know their setup fails sometimes. They know this is one data point in a series of hundreds. They note whether there was anything unusual about the setup or the execution, and if not, they move on. The loss doesn't shake them because it's expected. It's priced in. It's part of the process they trust. Over time, something else happens that's hard to describe, but you'll recognize it when it happens to you. The setup stops being something you do and becomes something you see. It's no longer a strategy you're executing. It's a structure you recognize the way you recognize a friend's face in a crowd. You don't think, is that them? You don't analyze the features. You don't check against a mental checklist. You just know, instantly, automatically, without conscious processing. This is the integration phase, the point where the behavior becomes automatic, where the knowledge becomes embodied, where the skill becomes invisible. You don't have to force yourself to follow the rules anymore. The rules are no longer external guidelines that you impose on yourself. They're internal reflexes. They're part of how you perceive the market. You don't see price action and then apply your rules to decide if it's a trade. You see a trade or you see noise. The filtering happens before conscious thought. And when that happens, trading stops feeling like work. It stops feeling like a battle between discipline and emotion. It stops feeling like you're managing yourself. It just feels like observation. You see the setup, you take the trade, you manage it according to plan, you exit, you move on. There's no drama, no anxiety, no second guessing, not because you've mastered your emotions, but because the setup is so deeply encoded that there's nothing to be emotional about. You're just doing what you do. The same way a musician plays their instrument, or a writer writes sentences, or a chef prepares a dish they've made 1,000 times. It's not hard, it's not stressful, it's just fluent. And fluency is what profitable trading actually looks like for most people. Not complexity, not sophistication, not diversification across 12 strategies, but deep simplicity. One pattern, seen 1,000 times, executed with calm precision. The market rewards pattern recognition, not pattern collection. This is the core truth that most traders miss. They think the market is rewarding knowledge or intelligence or hard work, but it's not. It's rewarding recognition, the ability to see an edge in real time and execute without hesitation. And pattern recognition only forms through repetition so focused that your brain stops having to think, through exposure so concentrated that the pattern becomes part of your perceptual field, through commitment so complete that you're not distracted by other opportunities or other possibilities. You just see your one thing over and over until seeing it becomes as natural as breathing. If you're watching this and you recognize yourself in the 47 saved strategies, if you see yourself in the constant searching, the perpetual learning, the collection of information that never quite becomes execution, here's the quiet invitation. Pick one setup, just one. It doesn't have to be perfect. It doesn't have to be the best setup in existence. It doesn't have to be sophisticated or impressive or unique. It just has to be clear enough that you can recognize it. It has to make sense to you intuitively. It has to show up often enough that you can practice regularly. And it has to have clear rules so you know when you're following it and when you're not. Once you've picked it, delete the rest. Not metaphorically, actually delete them. Delete the folder with all the strategies. Delete the saved videos. Leave the Discord servers where people are sharing new setups. Unfollow the accounts that post constant market analysis with different approaches every day. Remove the temptation. Make your environment support your decision, because if the strategies are still there, you'll use them. You'll rationalize why this particular situation calls for a different approach. You'll tell yourself you're just being flexible, but you're not. You're avoiding the discomfort of constraint. Then spend the next 6 months watching only that pattern. Trade it when you see it. Study it when you don't. Notice everything. The way it forms, the way it moves after it forms, the way it fails, the contexts where it works best, the contexts where it's marginal, the subtle variations that make a difference. Don't judge yourself if you're not profitable in month 1 or 2. You're not supposed to be. That's not the goal yet. The goal is exposure, repetition, building the neural pathways. You're not trying to make money, you're trying to become fluent. By month 3, you'll start to notice that some setups feel better than others. You can't always explain why, they just do. Trust that. Start passing on the ones that don't feel right, even if they technically fit your rules. You're developing intuition. That's good. That's the goal. By month 4 or 5, you'll start to feel the shift. The recognition will get faster, the conviction will get stronger, the execution will get cleaner. You'll stop checking and rechecking your rules. You'll just know. And by month 6, you won't be trading the setup anymore. You'll just be seeing it. It'll be automatic, reflexive, natural. And that's when the profit starts to feel inevitable. Not because you worked harder, but because you finally stopped looking everywhere and started seeing one place clearly. Not because you learned more, but because you went deeper. Not because you found the perfect strategy, but because you became fluent in one strategy. The market didn't change, you did. Your brain reorganized itself around one specific pattern until that pattern became part of how you see the world. And once that happens, trading stops being about trying and starts being about being. You're not trying to be a trader. You're not trying to execute your strategy. You just are. The pattern is there or it's not. You trade it or you don't. And over time, that simplicity compounds into consistency, into profitability, into the thing you were searching for all along by looking in 1,000 different directions when it was always waiting for you in one place if you'd only been willing to stop and look deeper.